Hello and welcome to Capital Market Live on Channels Television. I'm Will Ibang, and as always, let's check in on how stocks performed this week. We begin with Europe, where markets traded lower amid growth fears, expectations for further rate hikes and continued volatility in the energy markets weighed on stocks. France CAC 40 closed 1.31% lower. The German DAX tumbled 1.66%, while the UK's FTSE 100 rose almost 2%, fell almost 2%, while the UK's FTSE dropped to 0.62%. Now, the British pound dropped below 1.14% for the first time since 1985 as a combination of dollar strength and recession warnings weighed on the UK's currency. We move over to Asia, where shares fell on Friday as investors digest U.S. economic data and China's industrial production and retail sales figure for August, which beat expectations. The Shenzhen component in mainland China briefly paired some losses after the data release, but then extended losses and closed 2.3% lower at 11,261 points. And the Shanghai composite was down 2.3% at 3,126 points. Japan's Nikkei 225 fell 1.11%. And the Topix index slipped 0.61% to close. Hong Kong's Hang Seng index was down 0.8% in the final hour of trade. Now, stocks fell Friday in the U.S. as Wall Street wrapped up one of its worst weeks in months, and traders reacted to an ugly earnings warning from FedEx about the global economy. The Dow Jones Industrial Average dropped 0.45%. The S&P 500 shed 0.72% to end the week at 3,873 points. The Nasdaq Composite slipped 0.9% to finish at 11,448 points. It was the worst week for the S&P 500 and Nasdaq since June. Shares of FedEx plunged 21.4%, their worst daily drop ever, after the shipments company withdrew its full-year guidance and said it will implement cost-cutting initiatives to contend with soft global shipment volumes as the global economy significantly worsened. FedEx announcement comes soon after a hotter-than-expected inflation report in the U.S. on Tuesday, which raised concerns that the Federal Reserve will be forced to cause a recession to cool prices. That data sparked a decline of more than 1,200 points from the Dow. The three major averages suffered the fourth losing week in 5. The Dow Jones Industrial Average declined 4.1% this week. The S&P 500 lost 4.8%, while the Nasdaq Composite dropped about 5.5%. Now to the domestic equities market, where stocks were bearish, sentiments continued to dominate activities in the local equities market. The all-share index dipped by 0.44% week on week to close at 49,475 points. Joining me now to review the equities market and other developments is Mr. Tajuddin Olayinka, Chief Executive Officer, Wyoming Capital and Partners. Mr. Tajuddin, it's good to have you on the program.
It's my pleasure. Good evening.
Mr. Tajuddin, the stock market was in a negative territory for most part of the week. We can say it closed flat for just 1 week. We had negative sentiments throughout the week. And this is the second week in a row that the market is closing in negative. What happened in the market, and when are we likely to see the return of the bull?
Okay, yeah. The market is just reacting to the system that we have. Since the hike in MPR in May, the first one in May, and the subsequent one in I think about around July or so, late July. Market has remained unsettled. The uncertainty around equity pricing and the yield environment in the fixed income space have made equity market to be somehow rattled. Let me put it that way. So market is reacting to the uncertainty in the environment of both the yields and what we are getting as far as inflation is concerned. So because of the fact that MPR was raised to 13% and the subsequent one to 14%, that has made market to behave in a way that it remains in a repricing mode for too long. So that is what we are seeing, and I think for boost to return, it might take some time, because of the fact that even in August we had the inflation, rising to 20.52%. So this is really a problem for the market.
Well, we're seeing that banking stocks, the sell-offs in banking stocks contributed largely to the pullback we had in the market. We saw Zenith Bank, UBA, Access Holdings, Union Bank, pulling back the market. What would you say is going on with the banking sector, Mr. Tajudeen?
Yeah, I think it's just because that sector, that banking stocks are they are likely liquid. They are very liquid stocks. They are the stock that most traders always like to hold. And so once there's any issue with the market, that is always the first hit. The first sector to be badly hit. More so again because of the price, the fact that why investors are repricing stocks. Repricing. I mean, during the pricing of equities, they are also the banks are also repricing their loans, and so all these things are affecting what is happening in the banking industry because of the fact that this rising interest rate is actually affecting them, even though it should have been positive, but it turns out to be somehow negative for the market because of the fact that not many of their loan customers will be able to absorb the shock of rising interest rate and of course rising inflation. So these are the problems that is actually affecting the banking industry. It's just a temporary issue.
Okay, just looking at the NGX Group, this week they released a statement on their dividend policy, indicating a possible payout ratio of between 25% and 75% of their distributable profits of the same year to which the dividend is applicable. Can you tell us more about this?
Yes, what NGX has done there was to just, advise, shareholders that going forward, this is the way. This is our dividend policy. Every year that we are going to pay dividend, it will be within the range of it will be between 25% and 75% of our current earnings. So, in other words, if we do not earn anything this year, we are not likely to pay you dividend. That's what they are simply saying. Whatever we earn, the dividend we are going to pay must be from our current earnings. And okay, so if any year we don't pay dividend, we don't have any sufficient earnings to be able to pay dividend, then we will not be able to pay dividend. That's what they're simply saying.
Okay, so but is this the standard?
It's tied to current earnings.
But is this the standard practice among public companies? What is the standard practice?
Okay, well, it differs actually. It depends on companies. It depends on different companies have their policies. I think exchanges, NGX has adopted that because of the fact that it's an exchange, is a holding company for the exchange, for a trading platform that will actually from time to time, require investment. So what I said that if they don't make money, they are not likely to pay dividend when they don't earn anything that year. That's what that thing is actually saying. But for others, it's not so for them. Some companies may even prefer to pay dividend from their reserve. If you don't earn enough, if assuming that you earn 1 naira and you intend to pay 1 naira 20 kobo, you can take the additional 20 kobo from the reserve. Why the current earning will be able to be sufficient to take care of the the 1 naira aspect of it. So some companies will rely on taking more money from their retained earnings from their reserve, so that whatever comes from that revenue reserve can serve as dividend for that year. So that's what it is. It differs. Not many companies adopt this kind of policy. Perhaps because of, like I mentioned earlier, it's an exchange. Exchange might be saying that if you don't earn anything this year, we are not likely to pay dividend to anybody or to any shareholder. But that is also, tasking the management of the company to say, well, you have to be able to earn enough to be able to pay dividend every year. But for other companies, they have different, dividend policies. Not common. This one is not common with, all the companies in Nigeria, especially those of them who are, in the real sector. Those of them who are also engaged in other services. They tend to pay from reserve, even if they don't earn that year. But there's a limit to what you can pay from reserve. So, it's also important that you also try to earn, from time to time, make profit so that you can be able to distribute dividend to shareholders. So it differs. There are even some that may not even pay dividend. What they just do is to just give a script issue, bonus issue to shareholders. maybe it could be a combination of that as well. Strip and cash. They do that. It depends. Not many companies adopt this kind of policy, but I think it's actually to protect the exchange. Going forward, so that you don't pay dividend from zero earnings.
Interesting there, protecting the earnings. But we also saw this week the NGX had, flurry of events going on. It held a closing gong ceremony where UBA introduced the new group managing director, Mr. Oliver Alawoba. The bank also gave, interestingly, the bank also gave an announcement that it plans to increase lending rates by as much as 400 basis points. And this was according to Bloomberg. That is and what Bloomberg is saying is that the repricing of loans will affect all corporate, commercial, and personal banking credits. What are the implications of this decision for the bank and loan customers?
Well, like I mentioned earlier, most operators in the financial sector, everyone is busy repricing securities, repricing loans, even repricing deposits. You heard recently that the CBN, directed banks to actually raise, savings rates to 4%. That was instruction by VIA, asking them to raise interest rate on savings deposit by 4%. So once you have, to 4%, once you have that kind of instruction, it becomes clear that they also have to raise interest rate on loans so that they can recover their costs. Don't forget that it is from these loans and from other services that this bank render that they are able to recover their overhead. And so they have to bring all those things into consideration. Yes, it could affect some of their existing loan customers who will now have to bear the brunt of paying higher interest rate on loan on the running facility. So it could create some kind of problem in the area of customers not being able to pay as at when due, because when you have a situation where interest rate is too high, customers might not begin to do some things that may also affect their operation. So that is one for the bank. But for the customers, of course, what do they have to do? They just have to adjust, just the same way everybody has been adjusting the economy. We are in a critical situation where inflation is high, interest rate is high, and everybody is doing the pricing of whether it is your loan or it is security that you have in your portfolio, whatever you have in your portfolio, everybody is doing repricing. We are in a season of repricing of securities and repricing of loans. So what is happening? What UBA has said is not unique to UBA. It's a general practice in the industry at this time. Everybody is repricing, whatever assets they have, so that they can recover costs.
Don't you think, what about price stability in the market? Do you think it has something to do with what we're seeing now? Because if they're repricing interest rates and it's going higher than what, and that's cost of borrowing is going higher, how would we be able to stabilize prices in other parts of the segments of the market?
Well, at this time, it's going to be a bit difficult. Don't forget also that the government is also crowding out private sector borrowers, by way of either borrowing from the public also, or borrowing from central bank by way of fair ways and means. So all these things are affecting the entire economy, the entire market. Everybody has got to reprice, whatever they have so that they can recover costs. Yes, it's a major challenge to the market, and even to those businesses that are now compelled to pay higher interest rates. The cost of capital in the economy has actually gone up. It's not just today. The moment CBN came up with MPR of 13% and a very strong rise from that to 14%, it became clear that everybody will be compelled to adjust whatever they are doing. And so that is the state we are. We continue to see this pricing of assets, whether it's interest rate, whether it's loans or securities or what have you. Repricing, we are in a season of repricing of instruments. Let me put it that way. That's the season we are. And of course, everybody must bear that consequence.
We'll try to bear, Mr. Tajuddin, but it's not easy. We'll take a quick break now. When we return, the conversation continues. This is Capital Markets. Welcome back. If you're just joining us, this is Capital Market Live on Channels Television, and we've been reviewing the performance of equities markets and other key events that occurred during the week. Mr. Tajuddin Olayinka is still here with me to dive into these numbers. Mr. Tajuddin, we were talking about UBA before we left about the repricing of loans and the journey other banks are taking, are embarking right now, repricing loans in this high inflation environment. You talked about the effect of rising inflation as well. How do you see this panning out, Mr. Tajuddin? Especially numbers just came out that inflation is at 20.52%. How do you see this affecting the capital market equities, as it were?
The state we are in the season of repricing. In fact, if you look at it, since May that we had the first MPR hike to 13%, market has been in that repricing mode. Investors taking early profit to be able to come back to market again. What really happens that until we are out of this inflationary pressure, investors in the equity market will want to reprice securities to be able to get the best of the moment. So what is happening that they sell down or engage in massive sell-off to be able to buy back later at much lower prices, because they know that once inflation is high, and of course CBN is going to do a further hike according to what Emefiele said at the last MPC meeting, that once there is aggressive rise in inflation, they might also have to consider raising interest rate again. And so if that is the state we are, then of course you expect the market to remain the way we are, because quite frankly, market is even trying not to be extremely bearish, but at least we'll come to see market the way we saw it here, just like this week that has just ended, and the way we have seen it since the beginning of MPR hike. We'll be in that repricing mode, just the same way every financial every economic agent is actually repricing the assets. So that is the state we have. It's disturbing, but eventually market will recover, because usually anytime you have this kind of inflation, the market will want to see what will happen to the yield environment. Once fixed income space is settled in terms of yield, then of course equity market will also settle. It's just because fixed income market has actually not taken final position as to what the yield should be. Today we see yield inching up. Tomorrow we see it coming down. So until we are out of that uncertainty, it's unlikely that market will have a robust market at this time. We are in a season of repricing of securities. Let me put it that way.
So do we expect further hike in monetary policy rate, Mr. Tajuddin? As in, you're talking about repricing of loans, and everybody's antsy, waiting to see what the CBN monetary committee is going to do on Monday and Tuesday, the decision they're going to take. Do you think they're going to hike rates, Mr. Tajuddin?
Well, I think if you go back to what Emefiele, CBN governor, said at the last MPC meeting when he made that announcement of a hike to 14%, they asked him that question, and he said, yes, the moment they see aggressive rise in inflation number for August, of course, they may also have to do a further hike in interest rate. Maybe he will now begin to do a rethink, or maybe the entire committee, the entire committee of MPC will now do a rethink, looking at the implication of that, on the environment. Don't forget also that the hike in interest rate is not because the government or the CBN is trying to rein in inflation. It's because of the hike that we are seeing in other economies, especially those advanced economies that are also hiking interest rate. CBN is trying to avoid the situation where investors will now begin to engage in capital flight, where they now have to be taking money outside Nigeria to be able to get better return on investment. So that is why CBN is actually thinking with MPR. It's basically it's not just because of inflation, because if you look at it, you cannot continue to use demand side tools to solve the supply side problem. The problem of inflation is actually coming from the supply side of the economy. It's not demand side. And because of the fact that both these things are coming from two sides. One is domestic inflation, clearly from the supply side of the economy. The other one is imported inflation. That there is no way hike in MPR can control that, because the moment you control import from other countries, to be able to take care of our raw materials need and what have you, we will continue to bring in inflation from other countries. So we are bringing inflation from China, from US, from Europe, and from other countries that are also being affected by inflation, rising inflation. And then we also have our own domestic issue, which we have not been able to, to deal with because of insecurity and several that, including, exchange rate management. A lot of these are the issues. So we have, in fact, it's a double-edged sword. Let me put it that way. It's a double-edged sword. Unless, there are other things that we can do on the fiscal side, it is unlikely that the CBN will put a stop to hiking interest rate. Maybe what they do this time around will be to do 50 basis points or go as high as 100 basis points as they did last time. But I don't expect them to have, even have a 25 basis point hike in interest rates. I don't expect CBN to go to go more than 1%, to go more than 100 basis points that they did last time, because the state we have now, we have to put a stop to it. But like I mentioned earlier, there is no way CBN will stop raising interest rates at this time because of other advanced economies that are also doing the same thing. If they don't do that, there'll be the path of capital flow, and I think that is what CBN is trying to avoid. It's not that the CBN is not aware of the fact that raising interest rates is actually not addressing problem of inflation in Nigeria. It will address it because most of the problems that we have are coming from the supply side of the economy, not demand side. And so the raising interest rate will just further hurt the economy and create problem for investors, especially putting much threat on capital formation. That's the way I look at it. I only appeal to them to just do it moderately. If they are going to do it for that hike, you need more than 25 basis points or 50 basis points.
So how are real sector businesses, especially public companies, dealing with this inflationary pressure? It's been so many companies are already closing shop. How do you think this is going to, in the nearest future? Do you think they're going to continue to deal well with this? Are they going to close? Are more companies going to close up because of inflation pressure?
Yeah, it's unfortunate that we are in this very, horrible situation that real sector businesses, have to contend with this rising inflation and rising interest rate at the same time. The way is it does the same way other economic agents have been adjusting. They also have to adjust, and I think what they have been doing is that most of them have been adjusting one way or the other. In economics, we say that once a firm can cover its variable costs in the short run, it can still remain in business. What that means that even if you cannot cover your fixed cost, but you can cover your variable cost in the short run, you should be able to. You can still forge ahead, continue to adjust the situation. And in the long run, when all factors become variable, you must be able to cover all costs. So we expect companies to continue to adjust, even though the situation is not palatable to anyone. It's not even something that we're talking about. But it should be something that we actually address rather than talk about it. But what most of them have been doing is to engage in what we call shrinkflation. Adjustment is just across board. In the short run, firms in fact, public companies are expected to, adjust to variability of cost and cost pressures to be able to stay afloat. If you cannot, then you have to fold up. So that is the state we are. I think most of them are going through adjustment. We have seen some of them reducing the volume of the product that they have in terms of what they put in a package. They just, for instance, you buy biscuit now. What we see there is that instead of seeing 5 there, you probably will see 3, and they be charging the old price of the 5. That's what most of them are doing. But that depends on the elasticity of demand. If your product is such that elasticity of demand is high, then of course you are just in for it. You can't raise price anyhow. You just have to continue to adjust. At least make sure that you deal with variability of cost and cost pressure in the short run. This short-term adjustment is actually what is driving up inflation. So you rob me, I rob you. That's what is happening. The government is not helping businesses. Business is also not helping government. So the adjustment, the short-term adjustment, is what is bringing what I call short-term pain. That's what is going on. Everybody is adjusting, repricing, doing this, doing that to be able to cover costs. Don't forget the price of diesel has gone up, and so they also must try to see how best they can cover that cost. But of course, if elasticity of demand is high for you, you are in trouble. That's the issue for some of these companies. It's unfortunate anyway.
Mr. Tajudeen, very, very interesting anecdote you pulled out there. Customers are still probably finding it a shock to open a pack of biscuits and see 3 or 2 instead of 5. Mr. Tajudeen Olayinka, CEO, Wyoming Capital and Partners, many thanks for sharing your perspective on the program for us with this evening. Thank you so much.
Thank you for having me.
And that's it on Capital Market. Do join us same time next week. I'm Will Ibang. Bye for now.